When it comes to gold, it is tempting as ever to focus on the price. The financial press thrives on the drama of daily movement, the $50 swing, the intraday reversal, the analyst's breathless prediction of another round number on the horizon. Yet to dwell on the price now is to miss the point entirely. What is happening in gold is not a trader's story, but a systemic one, because beneath the noise of short-term speculation lies a profound shift in behavior, not among retail investors or hedge funds, but among the very institutions that once defined gold as obsolete. The world's central banks are not chasing performance. They are building insurance. Their renewed appetite for bullion is not an emotional reaction to headlines, but a structural recalibration of what constitutes safety. What matters in this moment is not how high the price climbs, but how deep the vaults go. In the past 3 years, central banks have acquired more than 3,000 tons of gold, the most intense official accumulation since the collapse of Bretton Woods. Each ton is not some speculative wager, but it's a logistical operation that involves transport, storage, and secrecy. Bars are weighed, they're audited and relocated under armed supervision. This is not a trade. You have to see it as an admission that trust itself has become a form of counterparty risk. It takes a peculiar kind of irony and perhaps a measure of institutional embarrassment for the same class of policymakers who once preached the gospel of fiat to rediscover the virtues of metal. For half a century, they assured the world that trust alone could serve as collateral, that the credit of a sovereign issuer was the most reliable anchor of value, and that gold's role as money was little more than a sentimental relic of a less sophisticated age. Yet the moment that those assurances began to ring hollow, the guardians of paper turned quietly back to the tangible. The modern monetary order, in truth, has entered a phase of self-doubt. It's not failed, but it has begun to hedge against its own premises. To watch central banks convert a portion of their vast digital reserves into physical bullion is to witness the system recognize its own limitations. The familiar narratives of tariffs, rate cuts, and liquidity provide convenient cover stories, but they explain symptoms rather than the cause. Because the real cause is simpler. Faith is finite, and the institutions that depend on it know this better than anyone. The very word collateral has completed a historical circle. For decades, it meant leverage, i.e. an instrument used to create credit from credit. But now it has returned to its original meaning, the thing that remains when all else fails. The transformation is philosophical as much as one would say financial. The world built after 1971 was designed to abstract wealth from substance, and it succeeded magnificently. It produced an architecture of transactions so dense and complex that the underlying assets became almost irrelevant. But in a world where sanctions can erase reserves and liquidity can evaporate overnight, well, abstraction has lost its allure. So it was perhaps inevitable that the custodians of the system would rediscover material comfort in the one thing that resists manipulation. Gold's appeal today is not some mystical paradigm. It's a mechanical thing. It cannot be conjured up by decree or nullified by legislation because it doesn't require a functional clearinghouse or a reliable network connection. It's the only form of collateral that settles itself. The psychological shift now underway inside the central banking community is subtle, but it's profound, because what was once dismissed as a primitive hedge is being reclassified as strategic independence. The move toward bullion is no longer confined to the usual suspects. Now, China and Russia may have initiated the trend for obvious geopolitical reasons, but Poland, Singapore, India, and even the Czech Republic have followed them with enthusiasm. The result is a quiet but unmistakable migration of wealth from ledger to vault, say from confidence to custody. These are not speculative allocations, but they are operational projects. The Bank of England has flown more than 100 tons of gold back from London. The People's Bank of China has increased its reported holdings for 19 consecutive months, though few doubt the unreported total is much higher. Even traditionally conservative institutions such as the Monetary Authority of Singapore have expanded their reserves, citing the need for resilience in an increasingly fragmented world. The word resilience now does a huge amount of work because it means in polite bureaucratic language that the system is no longer trusted to protect its own participants. This is what distinguishes the present moment from the ordinary cycles of accumulation that accompany recessions or crises. In previous decades, central banks bought gold when they were forced to, often in the wake of currency collapses or balance of payments panics. Today, they are buying it preemptively before a crisis rather than after one. And that pattern suggests not a reaction to stress, but a recognition of structural fragility. The fear driving this behavior is not fear of loss. It is a fear of exposure. Every institution, once it reaches a certain level of complexity, begins to engage in quiet acts of self-insurance. The modern central bank is no exception. What looks to the outside world like a coherent system of coordination is, on the inside, a collection of bureaucracies, each charged with preserving its own credibility. The official rhetoric of confidence and continuity disguises a more pragmatic reality. The knowledge that in the next major rupture, solidarity will give way to self-preservation. And that knowledge explains the current wave of accumulation far better than any movement in interest rates. For the first time in decades, central banks are behaving like the investors they once lectured. They have become participants in the same search for safe collateral that drives the private market. And the result is an odd symmetry. The institutions designed to manage trust are now hedging against its exhaustion. They call it diversification, but to me, it looks more like some kind of escape plan. Every ton of gold moved into a domestic vault is a silent referendum on the credibility of this post-1971 order. The institutions that built that order are now voting with their forklifts. It is a delicate process to watch because it reveals the fragility of an idea that has shaped the modern economy, the notion that value can exist without substance. And each new report of official buying is a small act of contrition, a confession written in metric tons rather than press releases. Now, of course, it is worth remembering that gold's current renaissance is not unique. Every great monetary experiment ends eventually with a return to matter. In 1971, the United States abandoned gold convertibility to escape the constraints of reality. By 1998, when the Asian crisis exposed the perils of dollar dependency, emerging markets began to rebuild their reserves in physical form. In 2008, when credit froze and counterparty risk became existential, private investors rediscovered gold as the last solvent asset. And in 2020, when money creation reached absurdity in the name of rescue, the credibility of fiat itself began to fray. What we are seeing now is accumulation of that long cycle of extraction and recoil. The more advanced the system becomes, the more primitive its hedges must be. Every generation of policymakers believes it has engineered away the need for elemental assurance, yet every generation returns to it. The lesson is always the same. Complexity multiplies confidence until confidence becomes the single point of failure. And when that happens, the cure is not another algorithm or liquidity facility, but the reassertion of weight and permanence. And this is the quiet logic behind central banks' behavior. They are not fleeing the system they built. They're inoculating themselves against it. Their FOMO is not speculative exuberance, but institutional fear, the anxiety of being the last to hold what everyone will soon need. In a divided world, there will be no shared reserve currency or universal clearing mechanism. Each sovereign will rely on what it can hold. To be the final buyer of real collateral is to be the first loser in a world that settles in kind. Now, the irony, of course, is that this self-insurance accelerates the very process that it seeks to contain. The more central banks hoard gold, the more the credibility of their currencies erodes. And trust is a public good. But gold, that's a private claim, because each bar transferred to a domestic vault removes the fragment of confidence from the collective pool. And as the pool shrinks, so too does the willingness to trust in promises alone. It's a slow, elegant form of monetary entropy, and it's entirely self-generated. Yet this is not the prelude to apocalypse. The system will not collapse. It will corrode through precaution. Every shipment, every repatriation, every additional ton marks another step in the long withdrawal from collective faith. The architecture, that will remain, but the substance that once supported it will have been quietly redistributed. Now, what's emerging is not a new standard, but a new awareness that even in the 21st century, the ultimate reserve asset is still the one that can be lifted, it can be counted, and it can be locked away. This institutional self-awareness, if that is what it is, distinguishes the present from the crises of the past. In 1933, governments confiscated gold from citizens to defend their currencies. This year, they're acquiring it to defend themselves. So the motivation has reversed, but the instinct is very much identical. There's a fear of losing control. And the difference is that this time, the fear is bureaucratized. It has become policy. So yes, the price will continue to oscillate and analysts will continue to argue about whether 4,000 becomes 5 or whether the rally has gone too far. But that debate is peripheral. The real story lies not in the chart, but in the choreography, the steady, deliberate motion of metal across continents, the slow reassertion of matter in a world that has tried to live without it. Now, it's easy to be cynical about these gestures, and after all, these are the same institutions that still speak the language of liquidity and confidence while quietly undermining both. Yet, there is also something oddly honest in their behaviour, because for the first time in decades, the world's central banks are admitting through their actions, if not through their words, that belief alone is no longer enough. The custodians of fiat have rediscovered mass. Perhaps this is what maturity looks like in a financial civilization, the moment when those who built an edifice of promises finally conceive that even faith requires foundations. The great irony of our age is that the institutions created to maintain confidence in paper are now the ones proving why confidence must always be collateralized. Gold's new relevance is not a triumph of some nostalgia, it's the return of consequence to a world that has forgotten the weight of what it owes. And if you want to jump on board just like central banks, when you click on the link below, book a strategy call today and tell them I sent you.